Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter and I'll go over some looking at the last previous cycle to see where things really took off and where it ended. I know a lot of people are getting a little bit afraid of the selling pressure in the markets. I know the banks, at least one of the banks over in Silicon Valley is having some problems. Maybe there's other banks and contagion possibilities. I'm not going to dive too much into that as much as I don't know the whole background on it, but I'm sure there is some sort of contagion. I'm sure it might spread somewhere. But I'm gonna keep doing what I'm doing, focus on what's in my control, and let's look at kind of previous cycles, how they played out, and how we'll say when things took off, given the Fed funds rate and where that Fed funds rate is at today. We can look at that. And then we'll also go through a bunch of other information from Twitter as well. So first, I'm going to start with the correlations. So let's go in there and look at the correlations. I put this all together. And what this is it's the Baltic Dry Index at the top. Crude oil is the blue line. The Fed funds rate is the orange. I've got U.S. housing starts in the purple. And then I've got the yellow on the bottom, the S&P 500. So I've got a couple of different lines here. Those lines are green, yellow, and red. Green being the start of the commodity bull market, yellow being where we are today potentially, and then red being the end of the bull market. And that end is when the credit expansion phase ends. So think of it as the housing market ceasing to pump credit into the system, which is the purple line. So I've got a couple of things that I want to look at. I'm comparing the Baltic Dry Index, crude oil, the Fed funds rate, housing starts, and the S&P 500. So when we look between a green line and a red line, that is a commodity bull market. The way that I determined where that commodity bull market started and ended was based off the commodity to stock ratio. So commodities were cheap and improving in 1999 and onward, and they peaked out and turned down in June of 2008, roughly, or slightly around that area. If we look at the Fed funds rate, it's a lagging indicator. The driver, in my opinion, is housing starts, and then this just lags behind it. So what we saw was an increased level in housing starts back in the mid to late 1990s. That's what put us into an expansionary phase and a credit expansion phase. And in 98, 99, you could see the Fed funds rate started to increase up. That increase up put pressure in the markets because of the inflation created by this credit cycle. So the housing starts and the loans coming against those new homes increase the credit in the system, which is inflationary. That inflation had an impact on the bond market, and people started selling bonds, and the Fed funds rate, they increased the Fed funds rate. It was going up, and you could see the housing starts start to go down a little bit during that increase of the Fed funds rate. It paused and it went back down in the 2000-2001 crash of the NASDAQ bubble. So what I think, at least the way that I look at it, the NASDAQ bubble was obviously highly overvalued. And that valuation it was very high, and the valuation of commodities was very low. And a small demographic came into home buying years, and that interaction of the demographic and the housing starts created an inflationary impulse into the markets. That impulse created an increase in interest rate, which sparked problems in the market. So the increasing of interest rates sparked a problem. That problem was realized by the markets, and then they lowered interest rates. Boom, 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 boom. They came back down. But they lowered the interest rates in a market where there was still home buyers, and they lowered the interest rates all the way down. The stock market recovered, started to come back up, and we had a very low interest rate. The housing starts continued to power forward, generating that inflation. The entire time this started, we had crude oil going up the entire time. So the money creation comes from the housing starts. The translator of inflation goes through oil, and the Fed funds rate chases the CPI higher. So we had one cycle up and down. The housing starts got through that cycle and then started tracking higher as the interest rates went down. They also started throwing out these crazy loans in the system. Stupid loans, like stuff that was just garbage. Garbage loans. We also overbuilt. On this section over here, we had a very full real estate housing market over here. We started to fill our inventories up, and then we started turning back down where the yellow line is, our housing starts. Our housing starts started to decline. And that was with a hyper supply phase of real estate. The Fed funds rate chased it all higher. It paused when the housing starts started to go down, and that's when the whole crash ensued afterwards. So the crash happened, and it was pretty delayed. It wasn't fast. The Fed funds rate stopped hiking in July of 2006, and they started lowering in August of 2007. So they raised the rates up and left them there for over a year. Over a year. During that time frame, we saw the Baltic Dry Index basically take off when they paused rates and went ballistic to the upside. We also saw crude oil go ballistic to the upside on this pausing of interest rates. It really started to take off. And then once we hit that hypersupply phase and the housing starts started to decline, everything collapsed and credit started to be destroyed in the system. A deleveraging event. Baltic Dry Index crashed. Crude oil crashed. The Fed funds crashed. We had a housing starts crash, and supply was filled with homes. And we also had the S&P 500 crash, all roughly at that red area. That was the end of the commodity bull market. That was the end of the inflationary expansion phase due to all of the supply that was created. They lowered interest rates, but housing still was slow to recover because the demographic ceased to exist to push that higher. So it wasn't necessarily the Fed funds rate that crushed this. It wasn't necessarily the housing starts that crushed it, even though I think it had a large impact because they built too many homes and went into a hyper supply phase. It was the demographic running out. And then when they built a little bit too many homes, and then the foreclosures of all those bad loans came. The foreclosures were due to bad loans. It was not due to people just not able to afford it. They made loans to people who couldn't afford it in the first place. They were bad loans. Now, this credit cycle, the expansion phase of this and the inflation and all that stuff created the price movements in the Baltic Dry Index, in crude oil, in uranium, and all these different commodities. That was the driver of it, in my opinion. The credit expanding in the system was expanding at a faster rate than what those commodities could supply at that time. So it basically put everything into a shortage. We heard that also in the 2020 medical event crisis. They said, oh, it's a supply chain problem. Well, yeah, you increase the money supply by 30 or 40%. It puts everything into a shortage. And that is what was one of the problems in the system, was that money that they had created and handed out. But if we look at where we are today, I would say that the green line is the beginning of the commodity bull market. You can see we're at the bottom here. One could even argue that 2016 could have been the beginning of it as well. But we have this bull market that's that's created. We have an increase in crude oil. We have an increase in our Fed funds rate. We have an increase in the housing starts that are still elevated, but kind of rolling over a little bit. And then we have an increase in the S&P 500. This looks very similar to the same moves that we had in 99, 2000, and then the pullback in 01, 02. This is the pullback of 21 and 22. And this is also the pullback in crude oil. We had a little pullback in crude oil as well from 2000 down to 2002. I think that's probably a good indicator of where we are at today, is maybe potentially somewhere in this general vicinity, or where the yellow line is. And the reason I'm putting that up is because I'm trying to use some data here to figure out where the heck we're at. We could even be, further along, like over here. And we can see that the Fed funds rate's starting to slow down. We could hike a little bit more, but we're probably getting close to the peak of this, where this yellow line is, somewhere in this range over here. One thing that you can look at to kind of say, to gauge kind of where we're at, is look at the Baltic Dry Index. We have this kind of hump here from 99 all the way down to the bottom of 02. You could say that that's a hump from 2016 down to 2020. You could argue that. We've got a squeezing up of the pattern here in 2006, and we have a squeezing up of the pattern here in 2023 that we've just broken out. So that yellow line is basically where this yellow line potentially could be. If that is the case, that puts you where the Fed funds rate is also mirrored, almost identical in this scenario. So we've got an identical pattern that's forming in the Baltic Dry Index from 2023 back to 2006. Identical Fed funds rate that is starting to peak and go sideways potentially at some point here soon. We've got oil that pulled back a little bit and then started to run. We've already pulled back a little bit, and maybe we run again and do kind of a blow off top in the future. And then we have the housing starts that have been going sideways. Now, the housing starts are not like they were in this 2006 scenario. They're actually more like the scenario I would say over here. They're kind of at the beginning. And the reason I say that is because we haven't built into a hyper supply phase. At least that's my feeling on it. We don't see the housing in the inventory. If we don't see the housing in the inventory, perhaps we're earlier than what I think. But, you could make the case that if interest rates stay high enough, that maybe we just cycle through this and we cycle through it again, like we did back in 2001. We cycle back down, we lower interest rates, and then we come back into another increasing interest rate environment. So we were either somewhere in this range there or somewhere in this range over here. It makes me think that we could be at either one of those locations, because not every single bull market is going to be exactly the same. I will say that we, at least according to the numbers in real estate, we are short 3 to 6 million homes. We are not in a hyper supply phase, which makes this a little bit more difficult to say we're at this location in the yellow right here versus last bull market. Although we have similar patterns that have formed. So this pattern could be this pattern here, which means this bull market is going to be gigantic. But it might not be. Maybe we're later in this bull market than even what I think, and that the supply will eventually come, and maybe we go into a hyper supply phase, and then we start the cycle again after a year or two from where we are today. That is also possible. So that is where we're at. A lot of it depends on the housing starts pulling back or moving up. If they move up, I think we've got more room to run. If they pull back further, then it could be signaling that we're more towards the 2006 timeframe. Looking at the Twitter, and again, if you want to follow me on Twitter, it's @finding_finance. Let's take a look at some other charts see what people are talking about. I've got Casper here. It says, how often do you get the feeling that you don't own enough physical gold and silver? I went through that whole time, I would say, in 2015, 16, 17, 18. I kept asking myself, do I own enough physical? And I just got to a point where I was like, I'm good. Even now, there's a lot of times, oh, I'll buy some more. I'm like, I'm pretty much good. I own a good chunk, and I feel pretty comfortable with it. So, but I used to ask this question a lot. Here is Scott says, lots of fear once again, but it looks like Dow is, until proven otherwise, just back testing the breakout area a bit like 2016. Now, 2016 was also, as I was doing those comparisons, that was one of the time frames. Was 2016 could have been the beginning of the bull market like it was in the year 2000, 1999, 2000. But we have a breakout of the Dow Jones. We're coming back, and maybe we take on and move on higher. Maybe not. We'll have to see. And here's got some other ones here. He says, major uranium names all sitting at support, not ruling out a false breakdown followed by a slingshot. But I'm cool as a cucumber. So he's looking at URNM, and we're kind of right on that support level that we've got there. We've got another one that's on support of the 200-day moving average for Global X Uranium ETF. We've got Denison Mines, breakout and a retest. If this holds, it's right on the 200-day as well. We could see a big move to the upside if that holds and reverses. And we've got Kazatomprom. Now, is this going to hold and reverse? We're going to have to find out. Are we going to get a little bit of a drawdown and then a slingshot? That's possible too. That is possible. But everything in terms of patterns here of humans interacting with each other, they all look pretty good. And it also looks good with what I just compared in TradingView there, where we're at with the Fed funds rate and previous cycles. We could be sitting in 2004 or 5, because that's when the housing started to roll over. And we had a lot more runway ahead of us, even with the housing starts coming back down. We still had a year or two left, because they peaked in 2005, and then the markets peaked in 2008. So that's about 3 years or so. And maybe that's where we're at, about 3 years left, 3 years left. Coming on down, we've got Eric Nuttall. It says, Goldman Sachs, we expect rapid 2023 growth in non-OECD demand to sharply outweigh the moderate decline in OECD oil demand. As a result, we still expect Brent prices to grind higher to 100 barrel by December and stay there in 2024. And that's, I think it looks good from what we looked at, the data there. And I think that is a potential possibility based off of China and some of these Asian demand. And we'll see how high it goes. If we see a large discrepancy in supply demand and a big deficit, then yeah, prices are going to go way higher. So it's a battle between liquidity and the dollar and credit destruction or slowdown in the United States versus other parts in the world that are increasing demand and liquidity. Happy Wine says, remember, there are 3 ways that housing market becomes a better value: lower prices, lower rates, more inflation. Most FinTwit pundits focus on number 1, projecting a price crash. I think 2 and 3 will do most of the heavy lifting. Mortgage rates dropping today. And remember, the affordability really got unaffordable when the rates moved. And I think that the affordability is hypersensitive to the rates, and especially the size of the rates that we had, how much they increased on a percentage basis. So I do think that number 2 and 3 will do the heavy lifting. I think number 2 especially. Here's one. It says the Fed. Okay, I already went over this one, so what we can end it there. But I just want to kind of compare last cycle, looking at this cycle. We're still early in this cycle. I don't think that there is a possibility that we cycle through it and then we do another decline in interest rates. Those interest rates are going to impact the housing market. The housing market reignites itself. We get a credit expansion phase again. and we go into another increasing interest rate environment where they all just take off, commodities all just take off. That is a possibility. There's also a possibility that, and this is what Powell says, and I don't know how he's going to pull it off, but he's going to hold rates up for a long time and try to kill that recreation of credit. But I don't know how that's going to work because the demographic's still there. They still want to buy homes. So as soon as the rates go back down, I think they're going to start to buy houses again, which increases the credit expansion phase and also brings about inflation, which then sends the commodities higher again. So I don't know how he's going to hold them down, at least my opinion on it. So that's where we are in the cycle. And we're right at that pause phase where he could pause here coming up at some point. I don't know the exact time frame, but I think, maybe a couple more raises or maybe a raise or two. Hard to say. And I think it also depends on, how other portions of the market are being impacted by the increasing interest rates. And it's going to take some time for all this to kind of roll through. We could see a pullback. We could see a recession. We could see a slowdown. We have to watch the housing starts. We have to watch all these metrics that we're watching, and hopefully we can see it before it happens. If not, I'm going to ride through it because structurally, just because you have a recession, it'll hurt demand, but it's not going to fix the supply side. It's actually going to hurt. It's going to hurt the supply side on a longer term basis, which is going to probably create a larger move to the upside because it's going to delay the supply from coming on. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. Subscribe to the website if you like. We'll catch you next time. This is Finding Value.